Good evening. Welcome to another edition of the Shadow Trader Video Weekly. My name is Peter Reznicek from shadowtrader.net. Happy Memorial Day. It is the official kickoff to summer. As such, I'm going to keep this video a little bit shorter, but I hope sweeter. We're going to be talking about something that I call the H pattern. This is a pattern that I've noticed that not many people talk about, but it's something that I mention quite often in Shadow Trader. It's a very important pattern, and the daily chart of the SPX and other majors is currently stuck in something called the H pattern, so we're going to go over that. We're also going to take a brief look at intermarket analysis of the major averages and contrast the weekly charts and the daily charts to see where we are, and also a brief tour through market profile, specifically just so we can see the extremely large gap that's above us now on the charts that formed this week. All right, without further ado, let's get into it. All right, so let's get right into it. As I was saying, this video is going to be discussing something called the H pattern, which is simply just looks like this. It's basically any time that a market double bottoms, basically, after having a protracted downtrend. That's what sets up the H pattern. And obviously, it just looks like a lowercase letter H. And the reason I mention this is because very often what will happen is you'll have new money shorts coming into the market, and they will, I believe, make the mistake of shorting the breakdown here of this low. And usually, because the market has already come down from this area, it's really bad location to be initiating a new short, and you get a violent upswing from there that tends to kind of come out of nowhere. If you look at the 15-minute chart of the ES, or S&P rather, this SPX, this happened on Thursday, and it was really just like coming into the bottom, and then out of nowhere you had this huge rip to the upside, and then it continues overnight because, of course, it's not enough to cover all your shorts right up into the bell at 4 o'clock, so there's more covering overnight, and boom, you gap up the next morning. So that is in essence the H pattern. And if we look at other majors, they look relatively similar. You have NDX also has the big H on it starting all the way from here. The only difference with the NDX is, and this is kind of a tell, it is somewhat weaker. You did have a breach a little bit below, and the Russell also, but again, showing relative weakness. I've been saying that the Russell seems to be leading down. The fact that the H broke easily is important to note. So this is actually a follow-through pattern and not a choppy pattern. And last but not least, you have the Dow, which is caught in the middle of the H. Okay, so basically, what is the takeaway here for next week? Be careful. I think the markets should move lower. I think the rut continues to lead in a way. It's very common for the H pattern on the double bottom to have a bounce, but the main thing to remember is that sometimes this can last longer than you expect, and you can have price action that builds out up here. And don't forget that price action can also resolve to the upside, because that is the nature of the H pattern. It stands for hell for shorts. All right, let's take a brief look at these majors on the weeklies, as I was saying, just to sort of give us some context of where we're at. Part of what is bouncing the market is also this 20-period moving average here on the weekly SPX. I would also like to mention that this move down thus far has been pretty benign, I think, to me, and there's really no Fibonacci that you can look at where to say, well, we're coming in halfway or anything. We're nowhere near it. So the market does have plenty of room to move to the downside, but it has also been quite benign on the upside. I think this double bottom low coming into next week is obviously key, and it is, of course, at a big round number, which is also helping the market to get a little bit of support here. So tomorrow, look for a break of, or I should say next week, which is a shortened week. On Tuesday, watch the 2800 level very carefully. A breach of that is going to really open up the potential to send the markets notably lower. I would say at least 25 points down to 2776 into here, and then we may be targeting some of these fibs if we were to go a bit lower as well. Let's look at quickly NDX on the weekly, a little bit more bearish chart, again right to the 20, same thing, although it is below the prior week's low, a breach there takes it to the 50, also not a Fibonacci retracement by any means, and the rut, of course, is looking as bearish as it can be, bearish as the others. For here, it's more of a box pattern, and notice that you have this low, you have this low, both of which are around number 1500. If this resolves to the downside, I would expect these fibs to be in play, which I've already drawn in from earlier. That would be 1442 and 1400 in the Russell. All right, let's take a brief look at market profile. As I said in the intro, mostly because I just want to show you the gap that is above us. I think this is also a relatively bearish sign. So notice that the activity on Thursday was quite bearish, culminating in a poor-ish low. I say poor-ish low because it is a lack of material excess. There are actually 2 ticks of excess down here. That's these little M period TPOs down here. There are 2, but 2 is the minimum number that we need to call it excess. So when it's 2 or less, I call it lack of material excess, or a poor-ish low. Not a classic poor low where there's 0 excess, but a poor-ish low. That also adds on to the short covering rally that started Thursday afternoon. I'll give you a pro tip. This is a sort of a market profile nuance. You do need the software to do this, but when a poor low or poor high is developing during the course of the day, almost always you can take a position going opposite that. So if you see the poor low developing, it's a buy. If you see the poor high developing, it's a sell. Usually the poor low or poor high will develop later in the afternoon, say 2 o'clock or after, and it is a good opportunity to buy or sell some futures in anticipation of the gap that night. Usually works pretty well. Or you can buy and sell some very short-term like SPX weekly options as well. But all that being said, again, as I was saying, the focus that I want you to look at is on the gap, which is really large. The Wednesday to Thursday move opened up this gap, and I like the way Window Trader makes these arrows between the gaps, the red arrow, because it is a downward gap. That filled only partially on Friday. So now the gap is actually from here to here, and that is important. If the gaps, as long as the gap stays unfilled, that has a more bearish import in next week's trade. If the gap starts to fill, that's a little bit less bearish. So keep that in mind. If price action just continues to the south side early next week without filling the gap, they're, in all intents and purposes, just leaving it there. Again, that would be a little bit more bearish. So watch that next week. That's going to be 28.42 roughly to 28.52. There's about 10 points left on that gap. All right, that's all for this week. As always, thank you so much for listening, and please hit the subscribe button so you can be alerted when new videos are posted to this channel. Monday is a market holiday. The markets will be closed. As such, we will be back at it on Tuesday morning here at Shadow Trader. And on behalf of myself and the entire Shadow Trader team over here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.